Something unprecedented just happened in global capital markets. And if you blinked, you missed it. BlackRock, the largest asset manager on planet Earth, managing over $14 trillion, just quietly repositioned $2 trillion in capital exposure. Yes, trillion with a T. And here's the shocking part. They did it without press releases, without headlines, without any fanfare whatsoever. This wasn't a rumor floating around financial Twitter. This wasn't speculation from some newsletter trying to scare you into clicking. This was real capital, real positions, being systematically relocated across global markets. And the direction of that move tells you everything you need to know about where the next wave of wealth creation is happening. In the next 20 minutes, I'm going to show you exactly what BlackRock is doing, where that $2 trillion is flowing, why this rotation is accelerating right now in early 2026, and most importantly, how you can position yourself to profit from this shift before it becomes obvious to retail investors. Because once this shows up on CNBC and Bloomberg as breaking news, the easy money will already be gone. Institutions will have already positioned, and you'll be buying at the top. Now let me give you context on the scale we're dealing with, because most people fundamentally misunderstand what BlackRock actually is. BlackRock is not a hedge fund making risky bets. BlackRock is not some investment guru acting on a hunch. BlackRock manages $14 trillion in assets. $14 trillion. That's larger than the GDP of every country on Earth except the United States and China. Put this into perspective. If the global stock market were a chessboard, BlackRock doesn't just have pieces on the board, they own the board. They're in your 401k, they're in your pension fund, they're in sovereign wealth funds, they're in university endowments. They own pieces of almost every major publicly traded company on Earth. Apple, Microsoft, Amazon, ExxonMobil, JP Morgan. BlackRock is a top 10 shareholder in virtually every S&P 500 company. So when BlackRock decides to move capital on a massive scale, this isn't speculation. This isn't gambling. This is calculated repositioning, based on data most investors will never see. Larry Fink, BlackRock's CEO, has access to economic intelligence that costs millions of dollars to compile. Teams of analysts study currency flows, demographic shifts, policy changes, and probability models that individual investors simply cannot access. But here's the beautiful part. We don't need their data. We just need to watch their hands. And recently, BlackRock's hands moved $2 trillion out of US market exposure and into emerging and international markets. Now let me be very clear about what this means and what it doesn't mean. This does not mean the United States is collapsing tomorrow. This does not mean you should panic sell your entire portfolio and move to Thailand. What it does mean is that the center of gravity for global growth is shifting. Capital flows like water. It always seeks the path of least resistance and the greatest return. And right now, for the first time in over a decade, that path is leading away from US equities and toward international markets. Now here's what separates institutional investors from retail investors. Timing. Retail investors react to news. We see a headline, we get emotional, and we buy or sell based on fear or greed. We are reactive. Institutional investors like BlackRock move before the news is even written. They position based on forward-looking indicators, not backward-looking headlines. And by the time financial media explains a trend to the general public, that trend is already crowded. The alpha, the excess return, is already gone. So the real question isn't, is the US stock market bad? The real question is, where is the next phase of growth coming from? And how do you position for it before everyone else figures it out? Let me show you the math driving this capital rotation, because once you see the numbers, the logic becomes undeniable. Last year, 2025, the US dollar declined significantly against a basket of global currencies. When the dollar weakens, your purchasing power drops. Even if your stock portfolio stayed flat in nominal terms, you still lost real wealth because those dollars now buy less. Now let's look at how global equity markets performed in 2025. Germany's DAX returned approximately 22%. Japan's Nikkei returned approximately 26%. The MSCI Emerging Markets Index returned nearly 30%. And the S&P 500 returned about 16%. Now, 16% is a solid return. Nobody's complaining about positive returns. But when you compare it to the nearly 30% available in emerging markets, you realize you left 14 percentage points of return on the table. That's the opportunity cost of home country bias. And here's where it gets even more powerful. When the US dollar weakens, foreign investments get a currency tailwind. You don't make money one way, you make money two ways, from the asset appreciating and from the foreign currency strengthening against the dollar. It's a double return. Let me give you a simple example. Say you invest $10,000 in a Japanese stock. The stock rises 10% in yen terms. Normally, you'd make $1,000, right? But if the yen also strengthens 8% against the dollar during that same period, you don't just earn 10%, you earn approximately 18%, the stock return plus the currency gain. This is why weak dollar cycles create massive opportunities in international equities. You're not just betting on companies, you're betting on currencies. And right now, both tailwinds are aligned. Now, I need to address the elephant in the room because I know what you're thinking. Aren't international markets riskier? Aren't emerging markets unstable? And the answer is, it depends on your time horizon. Over short periods, yes, emerging markets can be more volatile, but over long periods, 10, 20, 30 years, the data is clear. Emerging markets have outperformed developed markets because they have the one thing developed markets don't: growth. The United States, Europe, and Japan have aging populations. Birth rates are below replacement. Workforces are shrinking. Emerging markets like India, Brazil, Indonesia, Vietnam have young, growing populations. Young people work, spend, consume, and build. That is economic growth, and capital always flows toward growth. But here's the problem most investors face. You don't know which country to pick. Do you bet on India, China, Brazil, Taiwan? If you pick wrong, you could lose big. That's where the basket approach comes in. Instead of trying to pick the single winning country, you buy a diversified fund that owns all of them. And that brings me to the three specific ETFs capturing this capital rotation right now. ETF number 1, VWO, the Vanguard Emerging Markets. ETF VWO gives you exposure to the fastest growing economies on Earth: China, India, Taiwan, Brazil, South Korea, and more. Why does this matter right now? Demographics. These countries have young, expanding workforces. The average age in India is 28. In China, it's 38. In the United States, it's 48. Young populations power economic growth. Last year, VWO returned approximately 25%. This year, price action has been choppy and consolidating. But for smart investors, consolidation is good. It's not a bug, it's a feature. Institutions don't chase assets when they're screaming higher. They accumulate during quiet periods when retail investors are bored and looking elsewhere. Buying VWO today is like buying the S&P 500 in 2003. This is not a quick flip. This is long-term exposure to the next generation of economic superpowers. ETF number 2, EWJ, the iShares MSCI Japan ETF. This one surprises people. Japan? Isn't Japan's economy dead? Isn't it the land of the lost decades? If you still think that, you're looking at old data. The new Japan is fundamentally different. Japan has undergone massive corporate governance reform. Companies are prioritizing shareholder returns, buying back stock, increasing dividends, and improving efficiency. On top of that, the yen has been weak, making Japanese exports cheaper and more competitive globally. Companies like Toyota, Sony, and Mitsubishi are printing money. Last year, EWJ returned approximately 24%. At one point this year, it was up over 70% year to date before pulling back. Is the run over? Maybe, or maybe this is just a pause before the next leg higher. Here's what I know. Institutions love Japan right now. Stable government, world-class companies, a currency tailwind, and a market finally focused on profits. ETF number 3, EEEM, the iShares MSCI Emerging Markets ETF. This is the broadest emerging markets fund. It returned 34% last year. Let me say that again, 34%, while the S&P 500 returned 16%. This is the tool institutions use when they want to make a macro bet that global growth will outpace US growth. They're not betting on just India or just Brazil. They're betting that the entire developing world will outperform the United States. And right now, that's a very smart bet. If you believe the next decade belongs to emerging economies, you buy EEM and let it compound. Now, I need to address the psychology of this moment because understanding investor psychology is more important than understanding fundamentals. When you see headlines about sell-offs, when you see Trump tweeting about Greenland or tariffs, when you see drama at Davos, your instinct is to panic. Your instinct is to sell, preserve capital, and wait for clarity. That instinct will keep you poor. Here's what you need to understand. People panic, institutions reposition, Money doesn't leave the market during sell-offs. It just changes hands. It moves from weak hands to strong hands. Pullbacks are simply big players moving chips from one table to another. And here's the rule you need to internalize. Every major capital rotation feels uncomfortable before it feels obvious. Read that again. It feels scary and uncertain right before it becomes obvious to everyone. In 2009, buying US stocks felt terrifying. The financial system had just collapsed. Banks were failing, unemployment was spiking, it felt like the world was ending. But institutions were buying aggressively, and if you bought in 2009, you made 400% plus over the next decade. In 2020, buying during the COVID crash felt insane. The economy was shut down, nobody knew what was happening, but institutions bought, and if you bought in March 2020, you doubled your money in 18 months. The pattern is always the same. Maximum fear creates maximum opportunity, but only if you're positioned before the fear subsides. Now let me show you the massive mistake that 90% of investors make during rotations like this. They wait for certainty. They wait for the news to say everything is okay now, that it's safe to invest. But certainty is the most expensive thing in the world. Certainty only appears after the returns are already gone. BlackRock isn't waiting for certainty. Larry Fink doesn't have a crystal ball. He has probabilities, data, and the conviction to act when probabilities favor a specific outcome. If you wait for the all-clear signal from CNBC, you're buying at the top. By the time the water looks clear, the big fish have already swum away. Now, does this mean you should dump all your US stocks and go 100% international? Absolutely not. I would never tell you to act out of fear or make extreme binary decisions. This is about balance. This is about recognizing that leadership in global markets is rotating. You don't abandon the United States, you just allocate appropriately. I've talked about US sectors that are still strong, defense stocks, rare earth minerals, industrials. These are safe harbors inside the US market. But ignoring a global capital rotation when the largest asset manager on earth is moving $2 trillion, that's the real risk. You don't need to predict the future. You just need to follow the footprints, position early, stay patient, let compounding do the work. But there's another shift happening that ties directly into this capital rotation, and it involves gold and silver. This isn't just about prices going up. This is about a fundamental change in how the global financial system values these assets. Recently, under Basel III banking regulations, gold has been reclassified as a Tier 1 liquid asset. For decades, banks treated gold like a pet rock. Nice to have, decorative, but operationally useless. It just sat in vaults doing nothing. But now under the new rules, gold is treated as equivalent to cash. Banks like JP Morgan, Goldman Sachs, and HSBC can now count physical gold holdings as like 100% liquid capital. They can use it as collateral. They can leverage against it. They can use it to meet capital reserve requirements. Suddenly, gold isn't just a safe haven, it's a financial tool. And when the biggest banks in the world realize they can use gold to expand their balance sheets and create more lending capacity, what do? They buy more gold. That's why we're seeing gold hit all-time highs above $5,000 per ounce in early 2026. It's not just fear driving the price, it's utility. Gold is now part of the core financial infrastructure. And here's what this means for you. BlackRock, the institution managing your 401k, is positioning for this. Whether you personally own gold bars or not, this regulatory shift impacts the value of your retirement accounts because the institutions managing your money are reallocating based on these new rules. Now let me show you the panic playbook, because understanding this will save you from emotional mistakes that destroy wealth. We've seen this pattern before, especially during Trump's first term. Notice how bad news always drops on weekends. Why? Because markets are closed. They want you sitting at home Saturday and Sunday, stewing in fear, reading scary headlines, imagining worst-case scenarios. By Monday morning, you're terrified. You sell, the market dips, institutions buy your shares at a discount. Then Tuesday comes, the EU threatens retaliation. Trump doubles down, it feels like World War III is starting. But quietly, by Wednesday or Thursday, rumors emerge, negotiations are ongoing, talks are productive, progress is being made, and what happens? The market rallies, the crisis evaporates, and the institutions that bought your panic-sold shares on Monday are selling them back to you on Friday at a profit. This is a game played entirely on your emotions, and if you know the playbook, you don't have to be the victim. Notice that we're now 3 cycles into this tariff drama, and we still haven't seen specific legal details on implementation. That's not an accident. They keep it vague on purpose to maintain uncertainty. Uncertainty creates volatility. Volatility creates opportunity for those who stay calm. Here's what you need to do. Close the app. Seriously. Stop checking your portfolio 47 times a day. The constant stimulation, the red flashing numbers, the breaking news alerts, it's all designed to emotionally hijack you. The system wants you panicked, so you make irrational decisions. Wealth is transferred from emotional investors to disciplined investors. That's how the game works. You need to resist the urge to react. Calm down, do the research, make a plan, execute the plan, then walk away. But knowing not to panic is only half the equation. You also need to know exactly what to buy when everyone else is paralyzed by fear. The 3 ETFs I just gave you, VWO, EWJ, and EEEM, are the core plays for this global rotation, but there's one specific sector that historically thrives during geopolitical chaos. It's not tech, it's not real estate. This sector outperforms the S&P 500 by double digits whenever global tensions rise, and institutions are pouring billions into it right now. I broke down the top 3 stocks in that sector in another video with specific ticker symbols and entry points. The setup is perfect, and the window is closing fast. You need to see it before this opportunity gets crowded. If this analysis showed you a capital rotation you didn't know was happening, subscribe immediately and turn on notifications. BlackRock just moved $2 trillion. The only question is whether you move with them or stay stuck in yesterday's winners. The choice is yours.